This episode of Bulletproof Cash Flow is brought to you by Realty Dynamics. Learn how people like you can build substantial passive income while creating wealth for the long term through real estate investing. Visit rdyne.com. That's RDYNE.com.
And so just having a guy who's been around for 30 years, who knows what's going on in these markets, knows how to do the lease ups, the management. They've got a great management team. He's a partner on the fund and invested in it. And so, having that experienced partner helps.
Working because you want to, not because you have to, is financial freedom. And we want to help you create that. Welcome to the Bulletproof Cash Flow Show. We're going to teach you how to achieve lifetime financial freedom through real estate investment. Your host is a multifamily syndicator and property developer. He's done deals reaching into the hundreds of millions of dollars. You'll hear from experts in all aspects of real estate investment, finance, development, and management. Everything you need is right here. This is the Bulletproof Cash Flow Show. And this is your host, Augustino Pintus.
Hey everyone, it's Augustino. If you really want to get something out of life, you really need to go out and grab it. Now, when it comes to real estate, this is a no excuses game. Age is irrelevant, and we're going to really explore this with our next guest. Now, he started off his first business as a lawn mowing company back at 13 years old. So he's had entrepreneurship in his blood for a very, very long time. Now, in his junior year of college, he took a semester off to do some internships, and he got stuck in that route. And he could have been financially fine coming out of college, but instead he quit all that and decided to go into real estate. And since then, he's never looked back. So over the past 6 years, he's acquired over 1,200 apartments as the key principal in excess of $100 million worth of deals. Now, he's leveraged this experience in property management, financing, underwriting, acquisitions, asset management, and construction management, as well as implementing value-add plans for all these multifamily properties. Now, additionally, he's also the co-founder of Obsidian Capital. They're based in Austin, Texas. It's a real estate firm that really helps investors build wealth. And he's also the CEO of Real Estate Lab, a multifamily real estate company focused on managing the acquisitions and analysis process for multifamily investors. So it's a software that provides market data as well as market insight for people out there that are looking to do deals. Now, with all that, I'd like to welcome David Toupin to the show. David, buddy, thanks for coming on, man.
Yeah, thanks, man, for having me. I appreciate it.
You bet. Now, guys, like what David has to say, you can reach him via the contact page at realestatelab.com. Okay, David, go ahead and tell listeners a little bit about your journey.
Yeah, so appreciate the intro. I started, like I said, in college, or like you mentioned, in college. I really wanted to get into real estate. I was listening to podcasts, reading books, I got onto Bigger Pockets and all that stuff. And, I thought, like a lot of people, that you have to go through that typical progression of single family and then into commercial. So I did a very short amount of single family. I did a couple wholesale deals, like 3 or 4 or 5 months, and then said, kind of, screw it. I want to go straight into bigger deals. I want to do multifamily and buy apartments, commercial real estate. So read some books on it, started, networking with people in the space and talking to brokers. I think my superpower was kind of underwriting in the numbers, because from the start, I really grasped it pretty easily, right? Getting deals from brokers made sense. Hey, they're going to send me this deal. I need to turn around and figure out what price I'm going to offer them. And it all comes down to the numbers for that for me, right? I'm going to tour the deal. I'm going to walk it, figure out what work it needs done to it. But at the end of the day, I'm going to go back, throw that all into kind of my financial model and see what makes sense. And so that was kind of my start. I bought a 12-unit apartment complex. I think I was like just 20 years old, turning 21 when I first bought that. And then just kind of kept going from there. I bought another 12 unit. Then I bought a 96 unit, which was kind of like a game changer for me. I house hacked, for lack of a better term, I house hacked the 96 unit. I lived in it for about 2 years, oversaw all the renovations, hired and oversaw the management team. I self-managed the property, and That one was a great deal that kind of put me on the map. So since then, I've been kind of doing the same thing. I founded Obsidian Capital after that, which I actually sold a year ago. So I'm no longer a partner of Obsidian. I sold that company to a couple of partners last year, started my own company, Toupin Holdings. Right now, that's my real estate company. And we, kind of do the same thing. We're expanding into different asset classes. I have a self-storage fund. We're buying about $30-40 million worth of self-storage this year. We've got a bunch of multifamily projects in the works as well, some new development and existing. And yeah, I love everything about real estate. So that's all I do.
Cool. Well, I want to dig into some of those other deals you mentioned, the 12, and 96. But now, before that, though, you're doing the wholesale thing, right? You're doing the single family thing. A lot of people start off doing that, right? They start off doing the smaller deals, and then you got sick of it after a few months. Now, what made you really get tired of it? Like, what made you? Because I think I know why most people, they stay in it, and what makes them sick of it. But I'd like to get your opinion as to why'd you get sick of it?
Yeah, well, I imagine if I still kept doing that today, I probably could make good money. Maybe you can make $1 million a year wholesaling properties, which sounds great. But at the end of the day, are you really building wealth? So I wanted to build wealth. I want cash flow. I want to be able to go away for a year and my business, actually grows and not the other way around. And there's some people that really successfully do that with wholesaling. But to me, it seemed just like another job, right? You're only as good as your next deal that you're hunting for, which is your next paycheck. And when you stop hunting for deals, your income stops, as opposed to a cash flowing commercial property, whether it's storage, multifamily, office, whatever it is, right? You buy it. And as long as you're holding it and you bought it right, you're going to keep earning every single month. And it should appreciate. So.
That's right. No, it's the same thing, right? I mean, it's with single family, you're buying yourself another job, and unless you're able to scale it and grow it, we're dabbling a little bit back into single family, believe it or not. We are actually we have a lot of multifamily, a lot of development projects, all this stuff. We're trying to build a team to acquire these single families, but at the same time too, it's like we're building a business around it as opposed to the other way around.
There's great investments to be made in single family. The first house I ever actually bought, because I did some wholesales, but it wasn't until a year and a half ago I bought my primary residence here, which has honestly been one of my greatest investments. I bought it before Austin housing market started booming. And so you can't knock single family, but at the same time, it's different, right? Everybody's got different goals, and there could be money made in so many ways in real estate.
So tell us a little bit about these deals, and how'd you fund those? Did you use your own money, or did you raise capital from friends and family, or how'd you get them done?
No, I think I was about as close as you can get to being broke as for someone going into real estate investing. I had, I don't know, a couple $1,000s maybe in the bank, not enough to even put earnest money on one of these deals or deposit. So I had a partner that was lined up to do, that I found to sign on the debt, put up the earnest money, and then went out and just kind of went to town raising capital. I didn't have anyone lined up beforehand. Before I locked the deal up, it was kind of like find the deal first, figure it out later. And so I just went to town, going to meetings, meetups, networking events, cold calling people, literally anything I could do to get in front of people that had money. So, I didn't have any family invest. My first few deals, it was all just people I had never known before and started developing those relationships with.
Wow. Those must have been in very different markets than your hometown of Detroit, right? Because that to me sounds very risky. Usually I like to line up the cash first.
It is risky, man. But, for someone like me, I was 20 years old. How am I supposed to get an investor to say they'll invest with me? First of all, I have no track record. Second of all, I'd never done it before. I'd never even worked in the industry before. So without a deal, first of all, it's going to be hard to get a commitment regardless. But without a deal, it's going to be twice as hard because I don't have anything to actually put in front of them and show them. So I knew that I needed a deal to even be able to break into this business. I need something under contract. Without that, I was hopeless. So find the deal first and figure it out later. It was in the suburbs of Detroit. I've never actually invested in the city of Detroit, which is a lot rougher. But I invest in the suburbs, there's a lot of really nice, A, B, C markets to invest in. They're pretty steady.
Yes. That's right. So now, what sort of structures you put into place for a deal like this? Because I know there's a variety of different ways of structuring your deals, and it's going to impact your overall returns. Do you have like a preferred way, or is this one done a little differently? How do you typically put this stuff together?
Yeah, it was just trial and error back then. I think on those first two deals, I did like an 8-pref, 80-20 split, and then I did an 8-pref, 70-30 on my next one, and then just kind of switched it up. Every deal is a little different. I've done anything from those all the way to 50-50 no pref, just depending on the deal. So, if it's a good enough deal, we can kind of do a little bit different structures. I do a lot of joint ventures nowadays too. So just a whole variety of different structures. Some syndication, some JV, and then some I buy on my own.
Hey, Augustino here, and I would love to connect directly with you. Text the word books to 844-428-1344 to receive weekly book recommendations from me. Interesting. Do you find that, are you using the same investor pool for all these deals?
I have a lot of repeats. They're not always the same. Some deals I have, one guy that'll put $1 million check in, and then some deals I'll have 30 people who would put $100,000 to $250,000 check in. A lot of those same 30 people are repeat investors. I think I've had probably about 20 people that have done 3 or more deals with me at this point.
Yeah. I'm just curious, do you ever get any pushback from investors that say, hey, wait a second, last time it was a 70-30 split, now it's an 80-20 split. What's the deal? Do you ever get any type of pushback on stuff like that?
I actually haven't, no. I mean, I get a lot of first-time people who will see a structure and it just so happens that a lot of times it's their first deal they're investing in too. It seems like you get most questions from the people who it's their first deal and they haven't invested with you before. But the people that invest with me over and over again normally just say, hey, I trust you. You've performed well for me in the past. Just tell me where to sign and we'll come in. And so, that's kind of how it's developed over the years. But for people that are first-time investors, I'll get more questions on, hey, why was this deal structured a certain way? Or, how did you come up with this? And normally it's based on the return profile for the deal. We typically just try and earn investors a similar, consistent type of return. We're normally shooting for a 20% annualized return. So if that's a straight 70-30 split, or if that's a 8-pref, 50-50, we're shooting for that same return either way. We just kind of adjust the structure to hit it.
Interesting. Yeah, some I've seen a lot of syndicators, a lot of ones I've interviewed here actually. They typically structure it all the same way, or it depends on the risk level, right? Where if it's a development, they'll structure it one way. If it's a ground up, they'll do it another way. If it's a C class asset, B class asset, A class asset, whatever the case may be, right? So it's always interesting to get the different feedback on as to what investors think, because sometimes investors, like I said, they'll say 70-30, 80-20. Oh my God, this is perceived as good or not good. But in your case, you're hitting a target. Here's your target. I'm going to get you this, and here's how we're going to do it. So you're kind of backing your way into a structure as opposed to making the structure the key focus.
Correct.
Right?
Exactly.
Interesting. Yeah. Very interesting.
Yeah, and we've been fortunate. We hit it. We've hit it over and over again. So it's the way we've structured them has worked out.
Yeah. Well, I mean, that's a big part of it, right? I mean, obviously, if you've not been able to perform, these people would not just keep coming back to you and throwing down with you, right?
Correct. Exactly. Exactly.
So now you're in Austin, right? So it sounds like you made your way out of Detroit there, and now you're in Austin. What sort of deals are you picking up in Austin these days? I mean, are you still finding anything out there? Because I know how competitive that market is these days.
Yeah, it's unbelievably competitive. I mean, I've seen the average sales price for a C-class asset just in 3 years go from $80,000 a door up to $150,000 a door. So seeing that, and if you're close to downtown, C-class assets are selling for close to $225 to $250 a unit. So it's pretty incredible. Different from the Midwest where I'm from. as we talked about. And, you're buying stuff back there for 70, 80 doors still. And here it's not even comparable. I have a couple different projects. I have a 50 unit new development that's going up right now. I live about 2 miles from that. And then I have one closer to downtown, which is a 16 unit townhome condo conversion. So we bought them as apartments. We're putting about 65 to 70,000 a unit into these units. Really high end, waterfall, quartz countertops, brand new cabinets, soft close, high end flooring, all that kind of stuff. And we bought them. We're going to condo them out, which the process is already done. And once we finish the renovations in the next couple months, we're going to sell them individually. So it's kind of like an apartment flip to condos. And then we just launched this week a self-storage fund. So we've already got our first 3 properties under contract or acquired, and we're going to buy another 4 to 5. That's a $10 million fund. So the goal is to buy around $40 million in property, develop them out, and then and hopefully sell it for a good chunk more in a couple of years.
Oh, nice. So you're going to develop the self-storage business. You're not going to buy them then?
So we're buying our target criteria is we're buying existing sites with they could have 10, 20, 30,000 square feet of storage with additional land so that it's already zoned storage. And we just have to go in there, create the plans, and then get approvals if we're in the city limits, and then we can build. So it kind of saves us a step on the zoning, and then there's some in-place cash flow as well day one because we're buying an existing site. So we're not doing any raw land, unzoned, but it's all existing stuff with expansion possibility.
Yeah, well, I mean, you and I both know, to do the whole raw land development stuff is a whole tricky business.
Yeah, I try to avoid it. It's a pain.
I mean, it is. We do it here in Cleveland, so we know what we're doing. We have a good team that really helps us with all this stuff. They do all the legwork ahead of time. But when it comes to the storage space business, that's a whole different animal. That's a whole different animal right there. Yeah.
What I like about it compared to multifamily is when we're building, it's so much quicker. The design process is faster. It's a lot simpler on your MEPs, right? Your mechanicals, electrical, plumbing work. Site work's a little bit more simple. And then at the end of the day, you're just buying metal buildings, which are typically built by these companies where it's cookie cutter, right? They build these same things over and over again. And you're picking maybe different doors, different colors, and a little bit different structure, sizes of units. But they're building these metal buildings, and then they can go erect them in like 60 to 90 days. So once you get, it takes probably 6 to 7 months to build one of these facilities, where it could take a year and a half, 20 months to go build a multifamily facility. And design process is a lot quicker too.
Yeah. And then once you're done with it, it's it's far easier to deal with someone just storing their stuff as opposed to a picky tenant.
Yeah.
As opposed to people living there. Absolutely.
It is a simpler management process, a little different, but simpler for sure.
Yeah. So now, who are you partnering up with some folks on this one? Because if you're a multifamily guy like me and you're getting into that line of business, I know about it, but I would probably rely on some sort of management partner or someone that's done this before. I'm assuming you do the same sort of thing.
Correct. Yeah. So we brought in a management company as one of the partners on the fund, who has managed in Texas here for about 30 years. So they've managed in all the markets that we're investing in. And for example, one of the 3 properties we're buying up front, he just finished a development there about 2 years ago in this small town called Burnett. And he said they built about 50,000 square feet of storage. They filled it up in 90 days. And he's like, we should have made it double or triple the size. So when we found this new asset that we're looking to buy in that market, he said, it's red hot. I'll put together a market study for you, but we'll be able to fill up whatever you build there. And so just having a guy who's been around for 30 years, who knows what's going on in these markets, knows how to do the lease ups, the management. They've got a great management team. He's a partner on the fund and invested in it. And so, having that experienced partner helps, right? Because the financial side of it's very easy. It's very similar to apartments, right? You raise X amount of money, you go and get capital from a bank. The development process we're familiar with, but the nuances of storage, right, which is a little bit more, Apartments are supply and demand based, but I'd say storage is heavily supply and demand based, right? At some point, you could overbuild in a market, and you don't want to do that. So, we're making sure to focus on all those kind of metrics.
Yeah. Well, I mean, but in your case, there's a heavy influx of people from California moving into Austin.
Oh, everywhere.
We know that for all the tech jobs. Yeah. So very rarely is someone just going to go right to Austin and buy a house. They're probably going to move into an apartment. They're probably moving from a house into an apartment. They have all this extra stuff. Where are they going to put it? They're going to put it in storage.
Happens all the time. Yeah. In such a fast growing area like this, I wouldn't go do this back in Michigan, but in Austin, with the growth and the amount of homes being built and the jobs that are coming here and the people moving here, it's honestly, it's unbelievable. Like I could just notice monthly or quarterly the traffic going up higher and higher in each city that I go to. I'm like, 3 years ago there was not that many people, in the town that I live in, and which maybe had a 70,000-80,000 population, and now it's over 100,000. I mean, it's crazy. Yeah. So high growth.
I want to take a pause from today's show to share something that I've been encountering. As I speak to many investors, there's this concern, and the concern is centered around the inflation we've been experiencing and the devaluation of our currency. Now, we've seen some of the highest inflationary periods over the past 30 years. That's up over 8%. Economists actually believe that inflation is closer to 20%. Some say it's even more. Now, what does this mean for you? Well, it means that money that is sitting in your bank account or self-directed IRA that's not invested in physical assets that hedge against inflation are losing buying power. That means that every minute, every second, that dollar is becoming less valuable. You see this every day. You see this in the groceries you buy, the gasoline you buy, everyday items that you're buying on a daily basis are becoming more and more expensive, and you're using a less powerful dollar to buy these items. Meaning that dollar is losing value if it isn't put into a property that produces cash flow, just like real estate does. Now, our team here at Bulletproof Cash Flow has put together a series of weekly webinars that cover real estate investing like multifamily, net lease, and real estate development. Now, these are purely educational webinars. In these webinars, we talk about why real estate offers a powerful opportunity right now and why it makes sense to invest in these assets today. So, if you're interested in real estate or want to have the opportunity to get involved as a hedge against inflation yourself, I encourage you to go to bulletproofcashflow.com/webinars. That's bulletproofcashflow.com/webinars. Now you go there, these webinars are 45 minutes and they cover different topics every week. We go over the things you need to know to avoid some of the common pitfalls when it comes to investing while getting you prepared to invest your paper dollars into a real physical asset. Now, if you can't make the webinars, just go ahead and register and we will send you a recording that you can watch at any time. And by the way, these webinars are entirely free. There's no cost to you. This is just something that we do to educate our folks out there. So if you're enjoying this episode, please like and subscribe to Bulletproof Cash Flow. It helps the channel tremendously when you do. Now let's go ahead and get back to the show. Now, do you see yourself staying in self-storage then for the rest of the year? Or are you trying to pivot back into multifamily or other asset classes? Like, what's really, number one, I guess, what's really driving this change? And number two, do you see yourself going back to doing more multifamily deals?
Yeah, I'll always do apartments. I have deals I do on the side, like solo or JV deals. I have a portfolio back up in Michigan, so I'll always buy there if it's in the right market. I'll still buy down here in Austin. Just depends on the deal. But for this year, the storage fund is pretty much my sole focus. We're going to have about 7 or 8 assets in there, multiple developments going on. So I'm going to focus on that because the rest of my time is devoted to my software company. So I'll split between the storage fund and that for the time being.
Nice. Good. Well, let's talk a little bit about the software company. So I did spend some time on the website there. So it looks like you guys create tools to basically do some underwriting. So they're underwriting tools basically for multifamily type assets, right?
Yeah, it's like a CRM for multifamily investors and commercial investors to track the deals you're looking at, to underwrite those deals, to make offers, to store your documents that relate to those deals. And we're moving into some more features that we're launching in the next couple months that will bring a little bit more of like a data applications to the platform. Team management, track like tasks and stuff like that, task management. The goal is to automate the underwriting process. That's one of our major goals. So if you could go into a multifamily deal, upload a rent roll in T12, right now in Excel, if you upload those, it takes the unit mix automatically, it takes the T12 data automatically, and it will throw that into the financial model for you. It takes just a couple seconds. And then our goal is, in the next probably about 6 months, we're going to start providing a new feature where we can autofill your operating expense assumptions. So you don't have to go in anymore and guesswork on what your operating expenses are going to be. We're going to take market data from either national or your local market, and we'll be able to fill in what your repairs and maintenance budget should be, and your contract services, and your insurance, and advertising, and all those items. We'll be able to autofill that. So the goal is that you open up the analyzer, and you're a couple clicks away from it being completed for you. And then you could just, as a decision maker, make some adjustments, tweak it, and make financial decisions more quickly and accurately.
Nice. Well, now, what prompted you to create this tool? Because I worked in software, worked in IT before. Develop any type of tool like this sounds like it's not exactly simple, right?
It's not simple.
Not exactly easy.
I'm not from the software background, so the people building it are far smarter than I am. I've got a team in San Diego, and then we've got kind of a scattered internal marketing team as well. But
cool.
It's a whole new animal than as opposed to real estate. And software is expensive to build too, but it's really rewarding. It's cool to see the product come together. I started it because I had a spreadsheet analyzer for multifamily deals that I had started building. Really it started from my first deal that I did, and it evolved over time. And people started seeing it, asking about it. They eventually wanted to buy copies of my underwriting model that I built in Excel. And I think in 2019, I started selling it on my website. I just put on my website, it's like $250, and then it auto sent you the document. And word of mouth, I sold over $100,000 worth of a spreadsheet in like 12 months.
Wow.
And I'm like,
wow,
okay, there's something here. So people need a good model, obviously, that is easy to use, that they can trust the equations work. I've seen people lose $150,000 in earnest money because they went under contract with trusting an underwriter or an acquisitions person that used a faulty model. And I found the error in the model, and the returns were actually like 10 or 11%, not 15 to 20. And it made sense because every private equity group they went to fund their deal wasn't funding it. And they came to me, they're like, dude, am I doing something wrong? What's wrong here? And I was like, there's an error in your model. First of all, that's why the numbers looked like they were good, but they're not. And this deal doesn't make sense. And they had $150K hard, and they had to back out. They lost the money. And it was just because of an error in a spreadsheet that led to a bad decision. But then on top of that, right, a lot of people struggle with this. And so if we can autofill most of your assumptions and data, you just have to, go in there and make some decision maker assumptions and tweak the model a little bit, make sure everything looks good. But then you guys can make a decision on what price to offer. And now you've got a nice laid out analyzer with a good business plan. That's our goal. Help people do it. More people do it and easier.
Yeah. No, your analyzer is super, super important. And if you have faulty formulas, it could wreak havoc on your entire projection. It's terrible. It's terrible. So now, what skill would you say you developed to increase your business? Like, what is that one thing that you would say that someone would have to really do to really help their business?
Well, in multifamily and commercial real estate, I think having a thorough knowledge of the financial side is really important. Like, you can go and sell anything, right? If you're like a salesy type person. But imagine how much better of a salesperson you'd be if you actually knew and understood the numbers and the figures that you were selling. For anybody, right? involved in any aspect in this business, you need to know the numbers because it's a financial business at the end of the day. No matter what type of deal you're doing, single family, multi, commercial, office, retail, industrial, land, like a lot of it, it all just comes down to what are the numbers. And so I think that's a superpower of mine that I've always had. And I think everybody should at least have a thorough understanding of it, even if you're not the ones playing in the spreadsheets all day.
Yeah, 100%. Okay, well, we're coming down to that part of the show right now where I wanted to ask you about your opinion on something. Someone's listening right now, okay, and they want to get started with multifamily. They're not really sure what to do, even where to begin. What sort of bulletproof advice would you have to offer this individual?
Yeah, at the end of the day, you've got to take action. You've got to look at deals. You'll never become a multifamily investor if you're not making offers on properties. So you've got to go out and start figuring out how to find deals, creating a pipeline of deals coming through your inbox, and start making offers. And so learning how to underwrite deals and analyze deals is one of the most important parts of that equation. And so my advice to anyone that's looking to get started, get some deals coming in your inbox, underwrite them, figure out how to get the confidence to make an offer, and go from there. You'll figure the rest out after that.
Yeah. Love it. Yes. And no matter what, always give the broker feedback. That's how you build those relationships, right?
That's a great point.
Absolutely. Yeah, absolutely. All right, guys. Well, if you want to reach out to David, you can reach him via his website at realestatelab.com. Check out his stuff. He's got some really great material there that can really help you if you are indeed new to the business, to help you underwrite deals and understand what it is you're getting yourself into. So definitely check out his stuff. Thanks for tuning in, and I'll see you next episode. Take care.
You've been listening to the Bulletproof Cash Flow Show. We hope you've enjoyed the show. We know we had fun. Make sure to visit our Apple Podcast page and leave us a 5-star review. We hope you've gotten some useful and practical information from the show. For real estate coaching, events, and resources, hit up bulletproofcashflow.com. Till next time.
No information in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this show are limited to accredited or sophisticated investors. Any investments will only be made with proper disclosure and subscription documentation and subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice.